Are you ready to take charge of your money and start investing? Are you new to the Johannesburg Stock Exchange? Then this video is for you. Today, I'm going to break down how the Johannesburg Stock Exchange works, how to start investing, and more importantly, how do you align your investing ambitions with your financial goals. Hi, my name is Yolanda. I'm a wealth advisor. It is my goal on this platform to give you easy, actionable tips, content, and strategies that you can use to manage money well, to live abundantly, and to build generational wealth. If you're new to the platform, please consider subscribing. Be sure to like and share this video with friends or family that might need it. And remember, if you hear anything on this video, it is not financial advice. It's financial education to get you started. If you need financial advice, click the link where you're watching this video and I'll be happy to help. The Johannesburg Stock Exchange is the largest and oldest stock exchange in Africa. It's where companies list their shares, and investors like you can buy and sell a part of these companies. By investing in these companies, you essentially become a shareholder in some of the biggest companies in South Africa, like Naspers, MTN, and Vodacom. Think of it as a marketplace where businesses can raise money from investors in exchange for ownership. But before you actually go in and buy your first share, there's some things that you need to have in place. You work hard, you pay your taxes, and you still wonder where your money is going to. It's kind of like socks in a tumble dryer. That's where Solomon Wealth comes in. Whether you are planning for retirement, your kids' education, or looking to invest offshore, we've got your back. From estate planning to wealth restructuring, we tailor strategies to fit your lifestyle and goals. Don't let your hard-earned cash disappear like a cold castle at a rugby match. Partner with Solomon Wealth, where your money gets a plan, not just a prayer. Firstly, you have to identify whether you are investing for growth or you're investing for income. Investing for growth is ideal if you have a long-term vision. Also, if you don't have a huge sum of money to go and put into the JSE at one go, you want to make small deposits and buy shares a little at a time according to your budget to accumulate a larger lump sum. If you're investing for growth, you're looking for companies or funds with good growth potential. For example, startups. They're looking to raise money. They've got a unique product, a unique service, and they're looking to raise money on the JSE. So they're offering you ownership in the company. Maybe they're not going to pay you dividends right away, but they're looking to raise funds to go and research and develop and expand their company footprint. Here, you will earn your wealth through capital appreciation, the value of your shares increasing over time. If you're investing for income, you usually have a substantial amount of money that you want to invest and you would like to live off that income and you want to do that now. Ideally, you'll find retirees in this space where they collect their pension and now they're looking to invest into various options on the JSE, not just stocks, because the JSE offers you unit trusts and ETFs as well. Also, maybe you've come into an inheritance and you want to give up this 9 to 5 thing and you want to live off this inheritance. You take these funds and invest it on various options within the JSE to give you an income. You don't like the risk. You want good, steady income, maybe via interest or even rental income on the JSE through real estate investment trusts. Real estate investment trusts own property and they let it out, and you get a share of the rental as a shareholder in the REIT. So you can earn income through dividends, income through interest, income through rental. Many investors choose a mix of these income sources. Many investors choose a mix of both income and growth, some growth stocks for the long term and some dividend stocks for the short term. Which is your goal? Now that you've established your goals, you have to decide what you're going to invest in. But before you even go and do that, a thing that I like to encourage my clients to learn is understanding asset classes. Asset classes are basically your money squad of superheroes. It's like different players in the sports team. Each one plays a unique role to help you win the game. And in this case, it's to grow your money. The main asset classes are cash, bonds, shares or stocks, property, and even alternatives like crypto and gold. Cash is your safest player. It's not flashy, but it's always steady. Here you're getting interest income. Bonds are your dependable defenders. They don't score big, but they protect your money and give you regular interest. Shares are like strikers. Risky, but they can bring you good returns if the team, the company, does well. Property is solid. It's like a goalkeeper. It's valuable and it's long term. And alternatives, well, they are the wild cards. Exciting, but not always predictable. A smart investor doesn't rely on just one asset class. or just one type. They mix them up to balance the growth and the income, depending on what you are trying to achieve with your wealth building journey. That mix is called a diversified portfolio and is the key to building wealth over time. So if you're looking to invest for growth, you're looking at things like tech. Although we're quite advanced, there's still room to grow, and those companies are just expanding every day. Technology is improving at such a rapid pace. You want fast growing companies where people are just consuming those goods and services regularly. And if you don't know how to pick those companies, you're looking at unit trusts and ETFs. For income, you're looking at dividend paying stocks, the big established companies. You even get dividend ETFs. For rental, you're looking at REITs or property ETFs. You're also looking at bonds or bond unit trusts or ETFs. If you're not sure where to start on your investment journey with picking the right companies, unit trusts and ETFs are the safest place to start because these funds hold shares in the various asset classes. So if you're looking for dividends, you don't know what dividend shares to pick, you hold a dividend unit trust or dividend ETF. All right. That the manager that manages this ETF, it's his job to figure out which companies to hold. Right? They are qualified for this. They have all kind of expertise, all kinds of technology helping them decide which stocks to hold within that fund. So it takes the risk of you, the investor. Another thing that you must understand before you even buy your share is taxes on these asset classes. Because most of the times when clients come to me, they tried buying shares on their own, lose tons of money, and now they're looking for help. And I'm encouraging you to get help before you even invest. Right? If you don't know a lot of what I'm speaking about right now, you need help. Or this video can be a great thinking point where you're writing some notes down and you know what to go and research before you even invest. So remember, when it comes to your money squad, the various asset classes, now each one of them have a different role to play and they also tax differently. But you also have one more member of your squad, and that is SARS. He wants a slice of the action if your investments are making money. So interest is taxed according to the personal tax tables after applying the interest exemption of 23,800 rands. Shares and property, when you sell those, you trigger capital gains tax. There are different capital gains tax rules for various juristic entities, such as your natural person, such as a business, such as a trust. It's important for you to know this before you invest. Rental income from property, that is taxed like your salary. Even dividends get taxed. Local South African dividends are taxed at 20%, and that's usually deducted before you receive the dividend. If you're holding offshore ETFs or unit trusts, then you're taxed according to that local jurisdiction, whatever their tax rate is on dividends. So SARS is like that one kid who wants a share of your lunch. You can grow your money, but you got to play the fair game and share the portion with the country. Know the rules and you can still win in this investing game. So some common mistakes that you should be avoiding when it comes to investing on the JSE is one, trying to time the market. For example, you're waiting for a share to drop before you buy. It's an impossible thing to do. There's various strategies to avoid that. Second thing you got to know is you can't invest without pain. If you can't stomach the ups and downs of the market, stay away from shares. Know which asset class best suits you. Next thing is ignoring fees. Now, obviously, if you come to somebody like me for assistance, I'm going to charge you a fee where you can go directly with a fintech app or asset manager and bypass advisor fees, but you will have to pay them fees as well. So know the costs before investing. Another thing that you have to understand before investing is risk. Imagine the stock market is like a giant roller coaster. There's ups and there's downs. Sometimes it flips you upside down just for fun, and you pay them to do it. That's risk. The chance that the money you invest, the value can drop up and go down or even shrink. When you buy shares in a company, you're basically saying, hey, I believe in you. But if a company hits a rough patch, like a bad financial year or a global crisis, your investment can lose value. That's the scary part. But here's the cool bit. If you are investing for the long term, the trend on the stock market is it for generally to go up, but you have to have time. You have to be patient. The key is to stay calm when it dips. Don't put all your eggs in one basket. The more risk you take, the more the potential for gain, the more the potential for loss as well. If you don't like that potential, do not take the risk. Investing is like dating. It's exciting, it's risky, and it's better when you know what you're getting into. So now you've gone through all that, you know what your thinking points are, you've made some notes. How do you buy your first share? One, Go directly to a fintech app, go directly with an asset manager, or you can come see somebody like me who will go through this process with you, understand your goals, understand your risk appetite, and put a plan together for you. If that's something that you're looking for, I can help. Click the link where you're watching this video. Investing is one of the best decisions that you can make to grow your wealth. Remember to start small, be patient, and most importantly, invest according to your goals. Are you investing for income or growth? Let me know in the comments below. And if you want to watch more investing videos, click this link.